Well, earlier this month, BMO beat earnings estimates helped by improvements in wealth management and capital markets. William Downe joins us now in studio. Congratulations, 200 years. And in the environment that we've had at several points in time during that 200 years, it's pretty good to be still in business 200 years later. What's the environment like now for North American banks?
I think it's a good environment, Vonnie. We all came out of the recession in different states. Bank of Montreal came out strongly. We've been able to plow capital back into the businesses that matter most to us, and our U.S. business is not only much bigger than it was prior to the recession, but it's growing in a very healthy way.
Yes, it's interesting because a lot of the Canadian banks actually are making acquisitions. You've talked about tuck-in acquisitions in the Midwest, and one of your most recent ones was the GE Transportation Finance business. What specifically are you looking at? And obviously with the Canadian dollar to deal with as well.
Well, we have a long-term track record of investing. We acquired Harris Bank in 1983. At pretty close to book value. In 2011, we acquired Marshall and Ilsley, a 160-year-old bank, also very close to book value. And so when the market valuations are in the right place, we make large acquisitions. Tuck-ins work very well.
What about now, though? Are you seeing anything attractive?
Yeah, you know, I think in every segment there is potentials. Transportation finance was a good one because we have a large equipment finance business in the United States. This now makes us the largest financer of over-the-road trucks in the country, so a #1 market position.
William, you bought F&C Asset Management, the UK money manager, a couple of years ago. Does your M&A spectacles look outside the US now as it once did a few years ago when you snapped up that division?
Well, once again, if you look at the long-term strategy, we've been quite selective outside of North America. Asset management is one of the areas, and with F&C, we effectively doubled the size of our global business. We're a top 50 global manager of institutional money, $420 billion. So anything that increases the size of the customer footprint could be attractive. But, you know, the business has a very healthy level of organic growth, and I think we have the capital to support that as well.
William, I'm looking at the share price. It's at a record day, which is apt given this special day for you, this anniversary. I mean, a year ago, Canadian banks were hampered by souring energy loans, lackluster growth, and this sluggish Canadian economy. Since then, you know, you've bounced a third in value. Can you believe how far you've travelled in the space of a year? And can you look back with certainty that those days are for now behind us?
You know, I look at the fundamental value of the stock every day and think about how we're going to deploy capital. It is the case that large Canadian institutions felt the pressure of the negative Canada trade in the last year. So I would say it's more a case of a large short position against Canada as a commodity-rich nation coming off, as opposed to a run-up in the valuation.
You've been pushing for a Canada-China deal for a long time. You know, of course, it wouldn't be a bad thing at all. Does it help you if the United States pulls away from trade agreements such as NAFTA and such as, you know, even the WTO as an organization?
You know, I think we have to be very pragmatic about trade. Trade is good for business, and that's good for employment growth. So our relationship with China goes back effectively to 1819, but in modern China, we're one of the first banks to have a large financial services presence there. We're one of only 3 North American banks that has a fully licensed Chinese banks. I think that the movement of goods and services and capital and people between the United States and Asia is going to continue. I think being positioned as a bank with a long history in both countries allows us to function as a bridge. And you know, China has a big social issue just around the urbanization of a population that they have to digest. It's different than ours here in the United States.
Well, you're uniquely positioned then to give us a little insight into exactly how China's banking system is health-wise. There's a lot of talk about zombie banks in China, about the state financing the banks. In terms of what your bank is doing, what are you seeing? Are you financing real operations and growing organically there?
Yeah, we effectively facilitate trade and investment flows between North American companies, European companies, and China, and that part of the business is healthy. As far as the balance sheets of Chinese banks go, it's cyclical. As the economy accelerates, the bank's health improves, and when they go into a recession, it's a relatively young economy. Modern economy. As they go into recession, it puts pressure on the banking system, but it's a relatively stable system given the state support.
William, got to ask you about what's happening in the US. Your BMO Capital Markets division had a very successful year last year in deal making. Do you think you can win a bigger slice of US deal making in 2017?
Well, we've spent 15 years strengthening the execution capability of our U.S. capital markets business. We now cover more U.S. issuers than Canadian issuers. We have about the same size workforce in the United States as in Canada, and we've specialized in the mid-cap space, specific sectors, and that's why we're seeing the growth. And I think the prospects for economic growth in the U.S. continue to get better, and the prospects for our business continue to get better as well.
What about prospects for the Fed? Rate hike next week, what percentages do you put it? And if it's a yes, how many more this year?
Well, the market puts a 99 on it, and I tend to use the market as the best gauge. And I guess that the chairman has said twice more is possible. It's an inexorable march back to the neutral rate. I think that's what we have to focus on is that ultimately the Fed wants to get back to a neutral rate, and that's obviously very good for the banking system.
What is your neutral rate? Do you have one?
Just, you know, I would look at the long term or the last 25 years and reduce it maybe by a half. And I think that's because there's been structural changes in the economy, but that's still a full point and a half above where we are.
Well, following your most recent earnings report, some analysts did express a little bit of concern about loan growth moderating, and now we're seeing maybe net interest margins expanding if the Fed does indeed move. So what does that mean for your business, and how are you going to counteract any negatives?
Yeah, well, having a big, strong deposit base is a good thing. We have about 80 billion US in deposits. They obviously benefit enormously from the expansion of spread that comes from rising interest rates. Our commercial banking business was growing at mid-double digits for most of the time since the recession. It slowed to, 8, 9, 10. That's very good growth. In Canada, it's okay if loan growth is a little bit slower because the consumer is really, I think, at the limit of their capacity.
And the Canadian dollar, 134, where does it go, Bill?
Who knows? The Canadian dollar is influenced most by commodity prices. The one thing I will say about commodity prices is, well, they're well below what we would think of as maybe a long-term level. They have gone up considerably. They have appreciated considerably in the last 12 months. That's showing up, I think, in the strength of the currency, and I think commodity prices will continue to be strengthening.